Within 1 week's time, there were 3 bank closures in US. On 8th of March, Silvergate Bank collapsed. On 10th of March, Silicon Valley Bank closed. On 13th of March, Signature Bank's operations were stopped by regulators. For the case of Silicon Valley Bank, SVB, the California bank was closed by regulators following a botched capital call, and a rush of depositors withdrawing their funds. The speed of SVB's demise was especially striking. On Tuesday, SVB CEO Greg Becker was at an investor conference answering questions about what he does to relax. A few days later, the bank he led had collapsed.
The seeds of SVB's quietus were planted months ago. SVB was a bank popular with tech startups and had been serving both venture capitalists and business founders over the last few years. It provided the platform for movement of large seed fundings and enjoyed billions in deposits from these businesses. A bank might normally turn those deposits into loans to customers. But in part because of the tech boom, there wasn't a lot of demand for loans among SVB's tech customers. As a result, SVB decided to park that cash in US Treasury bonds, which seemed very reasonable choice at first. After all, US Treasury bonds are almost sold with zero default risks.
Unfortunately, the purchase of these bonds were done during a period when US Federal Reserve was aggressively increasing the interest rates. At the time of acquiring the Treasury bonds, the interest rates were still at their lows. Bond prices are inversely proportional to interest rates. As Federal Reserve increases the interest rates, the prices of the bonds dropped. Technically speaking, as long as SVB continue to hold on to these bonds, and not sell them at the prevailing market price, the drop in bond prices is merely a paper loss.
However, the tech boom had faded, and SVB's startup customers started to ask for their deposits back. Without enough liquidity to pay the customers, SVB eventually reached a point where it had to sell the treasury bonds it had invested, to have enough cash to return to the depositors. SVB was forced to sell US $21 billion in bonds from its portfolio, taking a US $1.8 billion loss, and seeking to raise money from investors to offset that loss. But the capital call failed, leaving a hole on SVB's balance sheet, and the rest is history.
The bank-run ripples in the financial markets are reverberating into the US politics. Joe Biden had to give a public speech of assurance on 13th of March.
All customers who had deposits in these banks can rest assured, rest assured they'll be protected and they'll have access to their money as of today. No losses will be, and this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers.
The Biden's administration is still in the middle of the battle to curb inflation in US, which had recently soared to levels unseen in decades. Increasing interest rates had been the traditional fiscal tool to combat rising inflation. Now, it has unintentionally resulted to the collapse of the banks like SVB.
The situation is putting the Biden administration into a dilemma. To save the banks, Fed had to stop further rises in the interest rates. This will stop other banks in similar financial position as SVB from closures. However, this will signal the return of inflation, which they just saw signs of slowing after the aggressive fiscal tightening in the past year. What should he do?